Definitely there's a change in tone, and two things have changed since the clip that you just played from Clarida. One is that inflation has slipped noticeably below their target. That wasn't the case a few months ago. And second, we have real tangible, we're in a trade war. I mean, we are actually in a trade war. There is risk of escalation of that trade war. So that's a material risk that looked like we were heading in a better direction a couple months ago. So I think the Fed is signaling greater flexibility, and that makes all the sense in the world.
Julia, I guess the other thing is we also saw some weak Eurozone inflation data today. We saw an Australian interest rate cut. Those factors also factoring in, do you think, in what the Fed's thinking, global growth and dollar strength?
Absolutely. The global growth picture hasn't improved, even though we'd seen some better Chinese data early in Q1. The global manufacturing PMI, for example, dipped below 50, dipped into recessionary territory. We're seeing, as you noted, weak inflation data. Oil prices have dropped. So a lot of indications now that we might need a little extra support. And what the Fed is signaling, which is, I think, important in the context of the policy debate taking place here in Chicago, is that when you're this close to the zero lower bound, actually, you, as John Williams said on Friday, you don't keep your powder dry. Sometimes you take out some insurance with a rate cut preemptively before the weakness actually washes ashore. So I think that's what we're seeing. I think it's June would be too early. We've got the G20s at the end of June, but maybe see how things go for a couple of months, and they're willing to go ahead and give a little boost to the economy.
Steve, it feels like we're in this never-ending loop where the market tells the Fed to cut rates, the Fed starts talking about rate cuts, the market applauds it, and it's just circular.
Rinse and repeat.
Who's making policy, the markets or the Fed?
So here's the problem I have. I said before, they might have more bullets than the other central banks, but in 1990, 2005, and 2008, the Fed cut between 5 and 6 percentage points. They don't have that ammo anymore. So for me, I'd love to hear Julia's comments on it. What do you do when they're out of ammo? Do you turn to QT or stopping QT immediately?
But Julia, to that point, there is scope for quite a few rate cuts that no other developed world central bank has scope for. That would add a lot of stimulus to the economy, wouldn't it?
Absolutely. So I'd make a couple of points. First of all, when the neutral rate is lower, so the prior cycles that were cited of 5% rate cuts, that was when the neutral rate was also a lot higher. So each quarter point or 50 basis point rate cut gives a lot more in terms of stimulus to the economy. And then I think the global dimension that you highlighted is important. The Fed is the most important central bank in the world. It is the only one with policy ammunition. Are you more likely to achieve your goal of a stabilization in the global economy with an early rate cut, an early small rate cut, or waiting until the weakness really gets entrenched? And I think what the Fed is signaling is that they're more leaning towards the former than the latter.
I mean, if their mission here is to boost inflation, Julia, is it going to work if they cut rates?
That's a much tougher question. And again, a topic of conversation here in Chicago. Inflation has been persistently low in all developed countries. The Phillips curve has broken down. What do we do about it? So I think that the Fed right now, in terms of thinking about its inflation goals, is looking over a longer horizon than markets. So the short answer is no. If they cut, say, 25 basis points or 50 basis points, it's not going to drive core PCE to 2.25 over the next 12 months. But over the cycle, if they implement easier monetary policy, more risk management driven monetary policy, they will achieve better inflation outcomes than if they don't. Because if you wait till the recession, the risks pile up and the recession comes and is deeper, you're going to lose a lot of ground on inflation. So inflation isn't high now, but it could get a lot lower in the next recession. And I think that's the through the cycle consideration that the Fed is trying to take on here.